Hello and welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Limited as part of the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to another episode in our series. Gold and silver prices have surged this year with approximately a 15% and 11% increase, respectively. Traditionally, interest rates and gold prices move inversely. So, high interest rates lead to a dip in gold prices, while rate cuts make the yellow metal more attractive. In the current scenario, the primary drivers behind rapid rise in prices are geopolitical tensions in the Middle East, expectations of interest rate cuts by the US Federal Reserve, and gold buying by the central banks as a hedge against their debt. In the middle of volatile market conditions, these metals are often seen as safe havens. However, purchasing and storing them physically can be cumbersome and time consuming. Investing in them in paper form, such as through ETFs, exchange traded funds, offer easier management. But is investing in them a viable option at this time? Today, we'll delve deeper into gold and silver ETFs, discussing who should consider investing in them, their significance in a portfolio, and what investors should anticipate from these precious metals. Today, our discussion revolves around investing in these ETFs. Joining us to provide insights on these topics are Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Mr. Bharat Pareek, who leads the product and segment teams at ICICI Securities Private Wealth Management Practice. Welcome, Mr. Haria and Mr. Pareek. So, to begin with, Mr. Haria, could you please elaborate on how gold and silver ETFs function and their underlying securities and the ease of operation for retail investors?
Varsha, gold and silver ETFs are very popular now. Silver ETFs were launched in 2022. Gold has been there as an ETF form for last 15 years. And with the metals shining, the popularity is increasing. The way they work is pretty simple. When you go and buy on the exchange a unit of the ETF, at the back end, there is physical gold which is stored in vaults. These bars are approved, regulated, audited, and so from an investor standpoint, they really don't need to worry about the purity or the content, etc., of the gold that is stored in the vaults. And there are rules and regulations around what can be taken in the vaults and what is stored behind. So the ETFs simply have gold or silver at the back end. We as an asset management company manage the gold and silver and the insurance risk, etc., for the clients. And the clients get the benefit of the prices of the gold and silver going up or down when they invest in the ETF form through their demat route. So it's making it easy for investors to invest in the gold and silver commodity without having to take the risk of the physical commodity being with them from a liquidity purity standpoint. Thank you.
Now, my next question is from you, Mr. Pareek. Could you share your insights on the reasons behind double-digit growth seen this year in these two metals, and if you can provide projections for the future as well?
Yeah, thanks. The recent increase in the price, I think you have to go a little bit back in history to really understand from where it's coming from. We had a gold standard. So monetary policies and all the monetary reserves we used to be backed by gold. As late as 1980s, 73% of the world international reserve used to be represented by gold. And when the gold standard was abolished, over a period of time, since 1980s all the way to 2010, for 30 odd years, central banks globally continue to sell gold and replace this with USD and or US dollar as we call them. So over a period of 30 years, we actually not seen accumulation of gold as a store of value or as a store of diversification. And that story changed in year 2010. And that is a time when the central banks globally as a one group started buying a net gold. And this number is now in excess of 1,000 ton every year. Now that is one big change in terms of the entire construct of the gold. Now you have to also understand that, as you rightly mentioned, why anybody will like to hold gold in their portfolio when it's not earning any assets, and as Chintan mentioned, is actually very difficult to hold physically, and you may need a manager to really manage this kind of a storage. and this actually changed the entire contour. And that's why the till you had USD as a one good alternative, you never looked at gold as a store of value. Now those equations have slowly and gradually changed today. First, whether you look at what's really happened in geopolitical, as you mentioned earlier, if geopolitical things are much more volatile, those conflicts are rising, the faith on each other is actually reducing, and as you see more and more developing countries and some other banks believes that you have to diversify away from gold. Now, gold has come in as a diversification. Today, gold only represents 16% of foreign exchange reserve of these banks. Now, all the ways from high 70s to 16 is a large drop. And as you might have seen, when there was a conflict between Ukraine and Russia, and when US decided to freeze US Russian assets, before that they have consciously moved away from USD to gold, and they were able to protect their FX. If they might have not done that part, it might have created a risk. Now that one action by US itself has created the need for diversification, and that's where the one big change happened, that now globally is getting slowly and gradually reconsidered as that if you really want to have a store of value, you need to have a gold. And that is the one reason you see central banks continuously buying gold for last now almost 14 years, and that pace at which they are acquiring is actually only increasing. The other part which is that debt to GDP ratio. Now as US debt to GDP ratio is rising, the reason for de-dollarization is also increasing. Now these are long term trends which are really evolving over a period of time. On top of that, we continue to see strong demand from retail investors and the physical gold holding. So today if you look at, it's just not a traditional way we used to look at a inverse relationship between interest rate, the real interest rate, what we call a net of inflation, and this one. So when you had a real interest rate negative, you normally will see that gold price move other way. But now when you see that the real interest rate is negative, gold prices are not only rising, but even when the real interest rate is positive, gold is rising. So that traditional linkages which we have seen over a period of last few decades is actually broken. Now whether this will continue how long is a question mark, but if you see the long term trends have actually changed. Now it's not just interest rate, it will only add fire to fuel to the fire when you see the interest rate falling, because then there's one more reason to buy gold. So today gold demand is driven by factors beyond a traditional just a real interest rate model. So I think that's the biggest reason. Second is the silver, which is equally important. Again, sorry, I need to take you back to the history, and you have to go as long as maybe 700 to 800 years back. The ratio between gold and silver used to be 1:7. Today that ratio is almost 100. Now earlier gold and silver both used to be considered in a single basket, right? And over a period of time, as gold became more and more difficult to extract and it became more and more rarer, the price of gold continued to rise, whereas silver, because of availability, easy mining, and a byproduct of lot of other mine, continue to be available to be mined at much cheaper cost, and hence over a period of time this ratio has expanded. But today, when you look at the demand supply equation of silver has also changed. Now, India, there's a single company in the country called Hindustan Zinc, has become a third largest producer of silver. Not because they've increased their production, because the other places the supply have reduced. Now today, because the supply demand supply equation has in silver has also changed, no new minings are coming. Now the byproduct of silver is also reducing. So you are when you are extracting other mines, silver is reducing, and the use of silver, which used to be traditionally utensils and to some extent industrial investment, it was considered as a low mean of investment. Now that is also coming. So industrialization use of silver is rising, including the EV, new environment, solar panels, new what all those chips and all continue to just for your surprise, the new edge AI chips also use gold as a production. It's very small portion, but just to add, gold is also used in chip making now, just because of the AI chips which you do. So it's very small portion, but the fact is today you have use of these things in industrial. So today industrial demand is increasing. The traditional demand of utensils, which used to be the largest portion of consumption, continues, and now the investment demand is coming. Now that is actually a recipe for a boom out movement in silver, the way we have seen in gold over last 10-12 years.
Wonderfully expressed, and thank you so much for taking us into the history and telling all about it. Now, my next question is to you, Mr. Haria. As gold has a low correlation with the equity market and it's often regarded because of that as a safe haven, can silver also be considered as a safe haven? Like Mr. Parikh has also explained it, but I want to hear your point of view also.
So effectively, there was a case earlier where equity markets and gold markets used to move in opposite directions, partly because what you mentioned, when interest rates go up, your equity markets come down. There is a safe haven investing which used to happen in gold from hedge funds. Now, hedge funds don't control a very large part of the equity markets, and hence, from a shift perspective from equity to gold is not happening because the AUM shift has happened towards passive ETFs in the Western market. To put it very simply, now the movement of equity is gold or all is risk assets is happening in tandem, and the reversal also is happening in tandem. When there is a risk off environment, there is a sell off in the financial world, and that sell off in the financial world is also impacting gold and crude oil as well and other commodities. So in the synchronized world where what happens with global central banks and their policies is impacting risk assets, gold and equities are actually moving in tandem, as has been seen in the last couple of years, where equity markets have done well. They are at an all-time high. If I may extend it to commodities, they are also doing extremely well because of a part of the flow is moving towards commodities because of the expectation of high inflation. And gold and silver, gold because of the reason that it is safe haven, plus the fact that when people do not know whether bonds will do well or equities, they're coming to gold. So equity is doing well, and the incremental money coming to gold is pushing gold up. And I'm just taking a leaf from what Bharat Bhai mentioned, that global debt to GDP is today 3 is to 1, $300 trillion debt, $100 trillion GDP. There's so much bonds, so much equities, and there is only as little gold as possible. I think about 14 to $15 trillion of gold. So even a small shift from bonds to equities takes gold higher, and hence gold and equities these days are moving in tandem. It may so happen that gold equity markets, because of certain increase in interest rates or global turmoil, may come down. At that point, as a safe haven investment, gold may go up. Silver is slightly different. Silver today, 3 years of consecutive deficit. Production is flat. Demand because of increase in electric vehicles, 5G technology, and solar is increasing at a rapid pace. And so silver is more today an industrial commodity and less as a bullion or a jewelry, etc., which means that with the applications of silver increasing by the day, we are seeing silver demand increasing meaningfully. So silver, irrespective of what is happening in gold or equities, because of demand being strong for new age businesses, is a commodity which is likely to be in a bull era over the next 2 to 3 years, unless there is supply increase, which is not going to happen. At least that doesn't look like, and demand continues to be strong. So silver is in a bull market of its own because of its increased usage or industrial demand, while gold, because of factors apart from its demand, like central bank in buying up equity markets being overvalued, can also do well. So both gold and silver could do well, but the reasons are slightly different. Thank you.
Now, Mr. Parikh, are all gold ETFs more liquid than silver ETFs? And what factors should investors consider before investing in them?
See, you started with gold ETF, and it's a traditionally been considered as the ETF, right? And that's why it's much more liquid. It's much widely accepted because of almost 15 years we've been having gold as an ETF option to invest. And it's a store of value, right? If you want to buy gold because you just want to buy gold in ETF form and store, so it's more liquid. It's and it's more acceptable as a traditional. Silver is a new product, right? It's a just to tell you, till we had this silver ETF, which was launched by ICICI, I think in 2022, as you mentioned, we had no choice to invest in silver. Silver was not possible to invest. You can't hold that large size silver bars with you and carry over, then store, then the entire ecosystem which you have to manage to maintain that. Now, only recent addition of silver as an ETF as a product has at least provided that opportunity to invest in silver. So I think silver is catching up. Gold has already done over a period of time. So gold is more liquid, but I think silver is catching up very fast. So I think maybe few years down the line, it will will be difficult to say which is more liquid and which is illiquid. Today, yeah, definitely, almost 47 crore of volume which happens in 42 43 crores of volume which happens in gold. I think that number for silver is just around 27 crore. So yes, today gold is more liquid, but yeah, I think few years I think we'll have a similar this one. While
Yes, just
investing, I think what you need to really consider is a few factors. One is liquidity, how liquid the ETF is, the particular ETF is. Second thing is that what is the bid-ask spread? What I mean to say is that at what rate there is a buyer and seller, and are you really able to execute at a transparent price? The benefit of ETF is the transparency of price, because it is such easily available and traded. If there is any difference in the real price which is on the ground and the ETF, that is taken care by some arbitrageurs. So broadly, it's more transparent, it's more aligned to the movement of the gold price, and the difference of premium and discount compared to the spot price is very less. So it's actually more transparent, much easier to execute. And what you need to consider is the liquidity and the volume, broadly, that is because that's broadly what reflects the ETF for you.
all right. So silver is comparatively newer than gold, so that is why it is less liquid now. But in future, you see that there are more opportunities for it because of its different usage. Now, coming to you, Mr. Haria, given that gold is primarily used for jewelry, while silver has industrial applications, as you have said, their prices movements are also influenced by different factors. In your opinion, which metal exhibits greater price volatility?
So naturally, gold being a store of value and more widely held, and silver being an industrial commodity which is less traded and less held, there is definitely more volatility in silver. Also, because gold is recycled, but silver recycling is not a very large part. If there is a sudden rush in demand for gold, there is a certain level of recycled gold which comes into the system to replace the deficit of production and supply. While in the case of silver, because the recycled silver is not a very big market and silver recycling is difficult to, because it is expensive to do it and it's not viable. If there is a sudden spurt in demand or a fall in production, the supply of recycled silver not being there, the movement of silver prices happens much more. So silver is much more volatile, and history has proven that when there is a rally in silver, it does a lot more in terms of percentage gain. And also the reverse, when the fall happens, silver can fall very sharply as well. And that has been witnessed even recently, wherein the movement of silver is much more than gold when it is moving up. And similarly, when it moves down, it can have a much more movement. So silver is more volatile, but that's the nature of the metal, I should say. But the good news is that going ahead, it may not show that kind of volatility purely because the demand is inelastic. The increase in demand is inelastic. In other words, it is a very steady growth in demand for silver while the production is flat, which means that the volatility of silver prices should be lesser going ahead, at least on the way down. And I think investors worry about the volatility on the way down. I don't think they worry about the volatility on the way up. So if the prices are going up, investors are anyways happy. But I do believe that silver volatility, while prices go down, will come down because of the supply demand being at a deficit for the last 3 years. So while gold will do what it does at a lower volatility as a store of value, and it should be a part of an investor's portfolio, silver, despite being more volatility, we do believe that it should also be a part of an investor's portfolio. 10 to 15% of your portfolio in silver plus gold, in the proportion that your risk appetite allows you, should be good. 70% in gold, 30% in silver is what we would probably feel is a good fit to start with, of course, depending on your risk appetite. Thank you.
Wonderfully explained. Now, Mr. Pareek, as you mentioned that gold is more liquid now comparatively silver ETFs. And in silver also, jewelry is not typically viewed as an investment. According to you, what is the preferred medium for investing in these metals? If not in physical form, then what? Is it ETF or is it mutual fund or digital gold or silver?
And I'll take this question in two parts. Gold and silver are separately, right? As far as gold is concerned, there are three, four avenues to invest. Obviously, physical is one, as you said, jewelry. But I think we consume, we don't invest. So jewelry is more a consumption rather than an investment. It's actually a backstop for a lot of at least the females in this country, where they consider that as their as a backup in terms of an emergency, and that is considered. But obviously there is a lot of cost associated, right, from making charges to the difference between the purchase price and the sell price. So that's a one option, but that's, I think, it's a more of a consumption rather than an investment. uh, Holding a bar, holding a coin, I think is not a great option in that sense, because it's has a lot of making charges and a price differential in terms of this. In that sense, I think a digital gold, a ETF, and a mutual fund actually becomes a much more preferred choice. As I mentioned earlier, it's a transparent price. You can see the price of the gold, and you know what price you are going to buy your ETF and sell your ETF. You know the price will get reflected in your price. It's easy to store. It's in your demat account. You can easily trade it. You don't really need to bother. It's executed on the exchange. So it's a lot of advantage which comes in. If you are doing it on an exchange, it comes in the ETF form. You can go to a mutual funds and subscribe without a demat account, also through a mutual fund scheme. So if you don't even have a demat account, you can go ahead and get it done through a mutual fund scheme. So that's also become another way of it. But as far as digital is concerned, I think they broadly are the same, whether you're doing through a mutual fund or an ETF or through a digital gold. There's another opportunity to invest in gold, at least, is called sovereign gold bonds. These are the bonds which are issued by Government of India on a regular basis, and they are also provided a very good alternative to invest in gold. Only thing is that always everything has an advantage and disadvantage. So advantage is that yes, they are available. They pay you 2.5% interest. The tax on these bonds are exempt, but you have to understand that you buy in the primary, you have to buy it, hold it till maturity. So you need to have a 5 to 8 years of time horizon to invest in those. If you want to exit, they are very thinly traded. You may not buy, may able to get a buyer when you want to sell. There are so many series that it's very thinly traded, so you really can't trade it. And the another last, but not the least, is that sometimes it may become difficult to even have a transparent price. So if the price of gold may be something different, but SGB may be priced completely differently. So there are disadvantages of SGB, but if you have a very long term holding horizon and you are looking for, then SGB can become another alternative. As far as silver is concerned, I think there are no alternative, right? If you really want to invest in silver as an investment option, there are actually physical is not an option. You don't have a jewelry, it's bulky, it's too tough to hold. And I think there is a only natural source is either you do through a digital, which is either mutual funds and ETFs. I think there are only two options which really provides this opportunity. And globally, it's a very large liquid markets. See, both gold and silver are global commodities. They are not India commodity. We don't determine the price of gold and silver. So today there is a lot of buying in India for gold and silver. That is not going to change the price of gold and silver. It will have its own ramification over a period of time, or as the demand supply equation globally changes. So because they are international commodity, prices are much more determined globally, and the physical demand supply is not that important. So I think the digital is a better way to invest in silver, that is either through a mutual fund or a ETF route.
All right, thank you so much for explaining this all. And rightly said that we do not have any product to invest in silver, such as a gold in the form of gold, so sovereign gold bonds. But otherwise, ETF is liquid and one can invest in that, whether it's gold or silver. Now, Mr. Haria, as commodity investments, they can provide diversification. But regarding taxation, gold and silver ETFs no longer offer long-term capital gain tax and index benefit. So given this, apart from diversifying the portfolio, as you said, the 10-15% is the standard, I suppose, for everybody for diversification. Are there any other advantages of investing in these metals?
So I think while 10 to 15% is a standard diversification, very few people actually have 10 to 15% of their financial assets in gold plus silver. So having interacted with so many clients, so many distribution points, 10 to 15% also is actually not the number which many people have in financial form or financial assets. So that is important for investors to keep a note of. Apart from that, of course, taxation changes did happen. So any investment in gold or silver, ETFs or mutual funds after 1st of April 2023 will not allow you to get any indexation benefit. So anything which was invested prior to that and you hold it, you continue to get the indexation benefit if you hold it for 3 years. So that does not change. So any investment prior to 1st of April 2023 made in gold and silver ETF, you are eligible for the indexation benefit. After that, of course, which is 1st of April 23 onwards, or now if you invest, that indexation benefit has gone away for gold, silver, any international funds which are there in India, or even debt funds. But that is at par with any other viable instrument that you have. So now you have to look at absolute level, what are you going to get, or in absolute terms, what is your expectation of returns for these particular commodities. And there, the belief is that if inflation is going to be strong, what debt will accrue to you in terms of returns. Gold and silver may have a chance of beating inflation. At least historically, gold has been able to beat inflation. Equities, no doubt, have been the asset class which has given the highest returns over a longer period of time, with higher volatility, of course. But yes, equities are a separate asset class. But gold and fixed income, if we compare, it has been shown that gold and maybe even silver over a longer period of time, especially when there is inflation in the economies, have done probably better. So in that respect, while the indexation benefit of taxation has gone away, as a diversifier to your existing portfolio, when equity markets in the last 4 years have done so well, and inflation is beckoning upon us in terms of its increase in the next few years, it makes sense to invest in gold and silver as a hedge against inflation and even global turmoil, which you and I can never predict. So diversifying of portfolio against a potential global ups and downs which may happen. Hence, gold and silver fit in well in your overall portfolio compared to maybe even fixed income or any other asset class. Equities is a separate asset class, which should not be compared with gold and silver in general. Thank you.
Okay. So these two metals are good for diversification, and 10 to 15, which is thought as the standard percentage to be allocated to these metals in the portfolio. Usually, people are not following it. Considering this, the current scenario, Mr. Parekh, do you believe that this is the right time to invest in either of these two metals?
Yeah, I think just like any other market, when you see the rise in the price in the recent past, and you always believe that will I get an opportunity to invest in this particular investment avenue at a lower price. I think that's a very difficult call for anybody to really do and time the market. What is most important is a long term trend and what you have a view over a medium to long term view. And in that, if you are really trying to do your asset allocation, as you rightly mentioned, and Chintan also highlighted, guys, don't follow that approach of investing, actually having a 10 to 15% portfolio. One way which we tell the clients and investor to do it is do 5% allocation in SGBs, which will become your long term holding, at least in the gold, and do a tactical play through ETF, because it's, as I mentioned, it's a transparent, easy to execute, liquid opportunity to buy. So I think that's a one opportunity. If you really don't have an allocation to gold and silver in today's portfolio, any time is a good time, as you know that you are taking this as a part of a diversification hedge of your portfolio rather than just one more investment class. I think there's no way you can say it's a bad time or a good time. You build it and build it over a period of time. As far as silver is concerned, I think at least current scenario shows that there is an opportunity for you to really take an advantage of this entire demand supply mismatches, both from the demand side, which is increasing, on the supply side where there is a restrictions, and over a period of time there is a correlation between the two which has broken as well, but it's again coming back. So if you see, normally this price moves in tandem, as earlier discussed, the velocity of the movement, or what we call the standard deviation, or the volatility of the product is higher in terms of silver compared to gold, but actually they move in a tandem. So that's very difficult to say that today is a time to really go and buy. But I think if you really don't have a diversification in your portfolio and you don't have these as a part of your portfolio, any time is a good time to build your portfolio and diversify.
Okay. So it depends on what is your requirement, and any time is good for investing in these. There is no right time as such. Mr. Haria, could you please tell us whether it is time to book profit on these metal investments because the rates are already high? People who have already invested in these precious metals, should they sell it and book profit now?
So yes, there is a feeling that rates are high. They are at an all-time high. but then which commodity or which equity market is not at an all-time high, right? So we are in a scenario where because of the printing of money, which Bharat Bhai mentioned since 1980,
Mm.
all assets are at their all-time high right now as we speak. There is a general rally which has happened. So everything looks at an all-time high, and if all-time high was a time to sell, then I think you would have sold long back and the markets would have kept on going up. So just because something is at an all-time high does not make it a sell. Just because something has risen in the recent past does not make it a sell. We must remember that gold for the last 11 or 12 years was virtually is actually virtually the same price. So 2011, $1,950 internationally. Today, it's about $2,300. So in dollar terms, over 13 years, gold has gone up by 20% absolute, which would probably be less than 1% CAGR, which even debt would have given a higher return than gold. So in dollar terms, there has been not much of a upside. Of course, in India, because of import duty plus rupee depreciation, we've seen 33,000 rupees of gold in 2011, translating to 70,000 rupees. But in dollar terms, it's a return which is very weak still. And if it is just coming out of its range for an all-time high, there are chances that it will continue to go up. I would believe that if you have more than 10 to 15% of your portfolio in gold or silver, then maybe you can look at booking some of the profits, if at all you have taken the full advantage of the rally in the last 3, 4 years. But where will you put the money next is the question, and there you'll probably not find an answer. So the suitable answer is stay where you are invested till you get an opportunity to invest, because currently, as things stand right now, gold and silver seem to be a better place compared to many of the other places or options which investors may have. Maybe large cap Indian equity is okay. Maybe to an extent Chinese equity is okay, but we do not know. Equities are risky. So in that portion of 10 to 15%, stay where you are, and probably in the long run, you will get the advantage of the growth in prices of gold and silver, given the uncertainties that are there in the world, and the demand for silver is improving as we see. Thank you.
Thank you, and wonderfully explained facts also. So if somebody has more than 10-15% and finds another opportunity to invest, then only withdraw, otherwise stay invested in these matters as of now. And here comes my final questions, Mr. Parikh. If an individual has no exposure to either of these, should they consider investing in only one of them or both?
I think I will definitely say one for stability and low wall. Second, for the way it is right now structured, I think you need to get both. The ratio you can decide based on your risk appetite, but I will say both, not one at the cost of others. Both has different reason, and both has a very solid reason to be part of your portfolio.
Right,
As
and
far as it is a part of your asset allocation, you are maintaining that 10 to 15% of your portfolio. You are not getting overboard or underboard. I think it's both have its own reason to be in your portfolio. Thank you.
And as Mr. Hari already said that 70 or 30 could be, you can think of it in that way, and based on your requirement, then you can change the ratio 70 to gold and 30 to silver.
Yes, definitely. Makes
Thank you.
sense.
I appreciate your explaining and providing clarity on gold and silver ETFs. The first gold ETFs were launched in India in 2004, and the first silver ETFs was launched in 2022 by ICICI only. They both have different factors behind their price movements and thus the volatility also. As one can use them for diversification, as we have discussed, 10 to 15% of the portfolio, everybody's requirement is as unique as an individual is. So choose what suits you best or take professional advice. With this, Investment Made Easy webinar comes to an end. Thank you, Mr. Haria and Mr. Pari, for joining us today and
Thank you.
sharing your
Thank you.
insights.
Thank you.
Viewers, we trust you found the discussion engaging and enjoyed the session. Please don't forget to like, share, and subscribe our channel to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We'll be back with our next episode soon. Until then, stay safe and stay informed.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.